Welcome everyone. Today, we are looking at the evolution of sustainable reporting in the Philippines, a journey defined by the shift toward ESG, environmental, social, and governance transparency. In the modern market, a company's value is no longer just about its profit margins. Investors and regulators now demand clarity on a company's carbon footprint, its labor practices, and the integrity of its board. This shift is not just a trend, it's a global imperative. To facilitate this transition, the Philippines has established a robust ecosystem of oversight anchored by the Philippine Sustainability Reporting Committee, or PSRC, which ensures our local businesses remain globally competitive. When we discuss ESG, we are really talking about long term resilience. Environmental factors, social impacts, and governance standards are the new metrics for success. Throughout this presentation, we will explore how the PSRC, our national standard setter, is driving the harmonization of these metrics, ensuring that Philippines corporations speak the same language of sustainability as the rest of the world. Let's start by looking at the regulatory foundation that makes this possible. To understand where we are in 2026, we have to recognize a major milestone. While the SEC's Memorandum Circular Number 4 Series of 2019 was our starting point, introducing a flexible comply or explain approach, we have now graduated to a more rigorous standard. The SEC recently issued Memorandum Circular Number 16 Series of 2025. This is a landmark regulation that officially moves the Philippines from a voluntary framework to a mandatory phased implementation of sustainability reporting. This transition, supported by the technical expertise of PSRC, which works hand in hand with the SEC to ensure these rules are robust. By adopting PFRS S1 and S2, the SEC has institutionalized a framework that holds companies accountable for their non-financial disclosures. The days of comply or explain have matured into a requirement for high-quality, transparent data. This ensures that when an investor looks at a Philippine company, they see the same rigorous comparable data they would expect from a firm in any major global financial hub. Now that we have established the regulatory environment, we turn to the central body driving this transition, the Philippine Sustainability Reporting Committee, or the PSRC. Formally established on October 21, 2022, the PSRC succeeded the Financial and Sustainability Reporting Standards Council. It functions as the architect of national sustainability reporting framework, ensuring the local reporting practices are aligned with global financial system rather than developing in isolation. Its core mandate its alignment with the International Sustainability Standards Board, or ISSB, ensuring that Philippine sustainability disclosures are globally comparable and easily understood by international analysts. To operationalize this, the PSRC issues the technical standards PFRS 1 and PFRS S2, which serves as the definitive rules for standardized, consistent, and reliable sustainability reporting. In doing so, it removes ambiguity from disclosure requirements and hold a uniform, high-quality reporting standard across all covered entities.
Leading the charge for the PSRC is Mr. Benjamin N. Villacorte, a proud graduate of San Beda University in 2003. Benjamin set a high bar for the profession early on by placing third in the May 2004 CPA licensure examination. Today, he is a partner at SGV & Co., where he heads the Climate Change and Sustainability Services and Financial Accounting Advisory teams. His background perfectly blends technical accounting precision with a deep commitment to environmental stewardship. With over 20 years of professional experience, Mr. Villacorte is more than just a chairman. He is recognized expert in sustainable finance and the circular economy. As a frequent research speaker, he helps bridge the gap between traditional business operations and the urgent need for climate action. Under his guidance, the PSRC isn't just about compliance, it's about preparing Filipino businesses for a changing global economy. But no mission this large could be done by only one. The PSRC is led by Mr. Villacorte alongside Vice Chairman Mr. Ignacio Carmelo Sison. The committee itself is a powerhouse of 18 diverse members. These experts represent accounting firms, business associations, and key regulatory bodies. This diversity ensures that the standards they set are not only technically sound, but are also practical and relevant to the unique challenges of the Philippine business landscape. PSRC's objectives is composed of three. First, the PSRC is responsible for issuing implementation guidance. Think of this as a bridge between global theory and local practice. When the International Sustainability Standards Boards, or ISSB, releases global rules like IFRS S1 and S2, the PSRC doesn't just adopt them blindly. They translate them into Philippine Sustainable Disclosure Standards. This is important because it gives Filipino businesses a clear way to do it. It ensures that the data being produced is high quality, comparable, and meets the rigorous standards that global investors expect from us. Their second objective is to be the voice of the Philippines on a global stage. Before any new sustainable rule becomes official worldwide, it starts as an exposure draft. The PSRC actively reviews these drafts and submits formal comments back to the ISSB. This ensures that the unique challenges of our local economy, such as our vulnerability to climate change or the specific needs of our MSMEs, are considered when global standards are being written. Finally, the PSRC acts as a lead coordinator. In the past, a company might feel overwhelmed because the SEC or the BSP and the PSE all had different reporting requirements. The PSRC fixes this by commenting on the proposed regulation of these financial sector regulators. Their goal is to align everyone by synchronizing the requirements of the SEC, BSP, and Insurance Commission, and even the Commission on Audit, or COA. The PSRC prevents regulatory overlap. This makes compliance more efficient for businesses and ensures that the entire Philippine government is speaking one single language when it comes to sustainability.
Now that we understand the objectives, let's look at the framework itself. This is where we see a monumental shift in the Philippine regulatory landscape. For nearly a decade, starting with the SEC's early efforts in 2019, sustainability reporting was largely a voluntary comply or explain exercise. However, under SEC Memorandum Circular No. 16, Series of 2025, we have officially moved into the era of mandatory reporting. The PSRC has established rigorous framework to standardize how companies disclose their environmental, social, and governance impact. This isn't just about green marketing. It is a communication tool meant to convince investors and the public that a company's actions are legitimate and data-backed. And this mandatory shift is built upon these three core pillars, which we will explain in detail today. Our first pillar is the standardization of emissions reporting. To ensure a transparent and data-driven analysis of a company's carbon footprint, the PSRC has adopted the global standard for categorizing greenhouse gas emissions into two essential scopes, Scope 1 and Scope 2. Scope 1 or direct emissions cover all the greenhouse gas emissions originating from sources that are directly owned or controlled by the organization. Think of it as a tailpipe, emissions from your company's fleet of vehicles, or the direct emissions from your on-site manufacturing facilities and furnace. This is data that the company has direct control over. Scope 2, on the other hand, or indirect emissions, accounts for the emissions resulting from the generation of purchased energy. While the emissions might physically happen at a power plant, they are attributed to your entity because you consume that electricity, heat, or cooling to run your operations. Distinguish the two is vital for risk assessment, as investors need to know whether risks come from operations or the energy grid, and the PSRC standardized these measures, ensuring consistency and a level playing field. The second pillar addresses the trust factor, the transition to external assurance. To elevate sustainability disclosures to investor-grade quality, the framework moves beyond simple self-reporting. First, we have independent verification. Companies are now required to have their disclosures audited by an independent third party. This adds a layer of skepticism and verification that ensures the data is reliable. Second, this verification must follow the ISSA 5000 benchmark. This is the international standard on sustainability assurance 5000, the premier global benchmark. It ensures that the audit itself is conducted with the same rigor as a financial audit. Finally, we look at the human element of this transition, the evolving role of the accountant. This framework redefines our professional responsibilities, moving our expertise from purely financial metrics to what we call environmental accountability. Accountants are now at the center of three crucial functions. First, technical verification. Accountants are now responsible for the precise measurement and verification of sustainability data. We are applying the same number crunching discipline used for balancing sheets to greenhouse gas emissions and climate risk. Second, regulatory compliance. It is the accountant's job to do and ensure that every report strictly aligns with the PFRS S1 and S2, our localized version of the global IFRS standards. And third, assurance services. Accountants are essential in providing limited assurance engagements, particularly regarding the integrity of greenhouse gas reporting. Now that we've covered the what and who, let's move to the when. To ensure a smooth transition, the SEC established a phased implementation timeline. This tiered approach allows larger companies to lead while giving smaller entities time to build their technical capacity. The rollout is divided into three tiers based on company size and market impact. Tier 1 covers our largest publicly listed companies, those with a market capitalization exceeding 50 billion pesos. These entities are the front runners. Their fiscal year adoption begins in January 1, 2026, with their first mandatory reports due in 2027. Tier 2 includes publicly listed companies with a market cap between 3 billion pesos and 50 billion pesos. Their adoption timeline follows exactly 1 year later, starting in January 2027, with initial reporting in January 2028. And finally, we have a Tier 3, which covers large non-listed entities, or LNLS, with assets or revenue exceeding 3 billion pesos. These organizations have until January 1, 2028 to adopt the standards, with their first reports required in 2029. This phased approach is strategic. It balances the urgency for transparency with the need for preparation, ensuring that all covered entities have clear and manageable path toward compliance. And this concludes our deep dive into the operational framework of sustainability reporting in the Philippines, moving us collectively toward a more transparent and accountable future.